Retire early worry-free, the lazy investor's guide to the SPLG ETF. Are you tired of confusing investment jargon and sky-high fees? Feeling lost in the stock market maze? What if there was a smarter way to invest, a secret weapon used by Wall Street pros? Introducing the SPLG ETF, your key to unlocking effortless market exposure. Forget expensive advisors and risky stock picking. The SPLG tracks the powerful SP 500, giving you instant diversification across 500 leading US companies. But wait, there's more. With an expense ratio of just 0.02%, the SPLG is practically free, leaving more money in your pocket for what matters. Want to build long-term wealth without the stress? The SPLG could be your game changer. Stay tuned to discover the magic of passive investing and unlock the potential of the SPLG ETF. Question 1. Why should professional investors consider the SPLG ETF as a core component of their portfolio? Here are some reasons why professional investors might consider the SPDR Portfolio SP 500 ETF (SPLG) as a core component of their portfolio. 1. Broad market exposure. SPLG tracks the SP 500 index, which represents the 500 largest publicly traded companies in the US. This provides investors with diversification across a wide range of sectors and industries, reducing their exposure to the idiosyncratic risks of individual companies. 2. Low cost. SPLG has an expense ratio of 0.02%, making it one of the cheapest ways to gain exposure to the SP 500. This means that a large portion of the index's returns are passed on to investors, compared to actively managed funds with higher fees. 3. Liquidity. SPLG is one of the most liquid ETFs, meaning it can be easily bought and sold in large quantities with minimal impact on the price. This is important for professional investors who may need to adjust their portfolio allocations quickly. 4. Transparency. The holdings of SPLG are fully transparent, and the index is rebalanced quarterly. This allows investors to understand exactly what they are investing in and track the performance of their holdings. 5. Tax efficiency. SPLG is a structured product, which means that it generates capital gains in the form of returns of capital instead of dividends. This can be tax efficient for some investors, particularly those in high tax brackets. 6. Benchmarking. SPLG is often used as a benchmark for actively managed funds that invest in large-cap US stocks. By including SPLG in their portfolio, professional investors can easily compare the performance of their active funds to the underlying market. However, it's important to note that SPLG is a passive investment and is subject to the risks of the overall market. It does not attempt to outperform the SP 500, and its returns will closely track the index. Therefore, it may not be suitable for investors seeking high returns or those with shorter investment horizons. Question 2. Why does the SPLG ETF choose to track the SP 500 index specifically, rather than other benchmark indices? It's important to clarify that the SPLG ETF doesn't choose the index it tracks. The decision to track the SP 500 was made by State Street Global Advisors, SSGA, the issuer of the SPLG ETF. They likely chose the SP 500 for several reasons. 1. Popularity and recognition. The SP 500 is one of the most widely followed and recognized stock market indices in the world. This means that there is a large demand for an ETF that tracks it, and investors understand what they are getting when they invest in SPLG. 2. Representation. The SP 500 is comprised of the 500 largest publicly traded companies in the US, encompassing a diverse range of sectors and industries. This makes it a good representation of the overall US stock market, offering investors broad diversification. 3. Liquidity. The SP 500 is also one of the most liquid indices, meaning that the underlying stocks can be easily bought and sold. This ensures that the SPLG ETF itself is also highly liquid, which is crucial for investors who need to trade their holdings quickly. 4. Performance track record. The SP 500 has a long and proven track record of outperforming other asset classes over the long term. While past performance is not indicative of future results, this established track record makes it an attractive benchmark for many investors. 5. Benchmarking. As mentioned earlier, many actively managed funds use the SP 500 as a benchmark for their performance. By tracking the SP 500, SPLG allows investors to easily compare the performance of their active funds to the broader market. 6. Competition. There are many other ETFs that track the SP 500, creating a competitive landscape. By offering a low expense ratio, 0.02%, SPLG can position itself as an attractive option for cost-conscious investors seeking broad market exposure. Question 3. Why does the SPLG ETF employ a passive investment strategy instead of an active management approach? There are several key reasons why the SPLG ETF chooses a passive investment strategy instead of an active management approach. 1. Low cost. By passively tracking the SP 500, SPLG can offer an expense ratio of 0.02%, making it one of the cheapest ways to access the US large-cap market. This is significantly lower than actively managed funds, which typically charge fees of 1% or more. This translates to higher returns for investors, as expenses eat into overall performance. 2. Transparency. As a passive ETF, SPLG holds all the stocks in the SP 500 index in proportion to their weight. This complete transparency allows investors to easily understand what they are invested in and track the index's performance. Conversely, actively managed funds keep their investment strategies secretive, making it difficult for investors to assess their true value proposition. 3. Tax efficiency. SPLG generates returns of capital instead of dividends, which can be tax advantageous for some investors, particularly those in high tax brackets. This is because returns of capital reduce the cost basis of the investment, potentially lowering capital gains taxes when the shares are sold. Actively managed funds, on the other hand, often distribute dividends, which are taxed immediately. 4. Market efficiency. The efficient market hypothesis posits that all available information is already reflected in asset prices, making it difficult for active managers to consistently outperform the market over the long term. SPLG avoids the risk of underperformance by simply tracking the market as a whole. 5. Diversification. Passively tracking an index like the SP 500 provides instant diversification across hundreds of companies, reducing exposure to individual company risk. Actively managed funds may hold fewer stocks, potentially concentrating risk if their stock picks underperform. 6. Liquidity. SPLG enjoys high liquidity due to the underlying SP 500 being a highly traded index. This allows investors to easily buy and sell shares without significant price impact, unlike many actively managed funds with potentially low trading volumes. However, it's important to acknowledge that the passive approach of SPLG might not be suitable for all investors. Those seeking to outperform the market through active management or targeting specific sectors might choose different investment vehicles. Question 4. Why should investors trust that the SPLG ETF will accurately replicate the performance of the SP 500 index over time? Investors can have significant confidence in the SPLG ETF's ability to accurately replicate the performance of the SP 500 index over time, but it's important to understand the nuances. Structure and tracking. 1. Physical replication. SPLG primarily uses a physical replication strategy, meaning it holds all the stocks in the SP 500 in the same proportion as their weight in the index. This ensures close alignment with the index performance. 2. Sampling replication. In some cases, SPLG might use statistical sampling to hold a representative basket of stocks instead of the entire index. This can be slightly less precise, but can improve tracking efficiency and reduce costs. 3. Rebalancing. The SP 500 rebalances quarterly, and SPLG adjusts its holdings accordingly to maintain the desired weightings. This ensures the ETF remains aligned with the index composition over time. Transparency and oversight. 1. Independent custodian. SPLG's assets are held by a reputable independent custodian, ensuring they are safeguarded and used solely for tracking the index. 2. Regular reporting. SPLG publishes detailed daily and monthly reports on its holdings and performance, allowing investors to monitor its adherence to the tracking objective. 3. Regulatory compliance. SPLG is subject to various regulations and oversight by financial authorities, ensuring its operations comply with established standards. Limitations to consider. 1. Tracking error. While close, SPLG's performance won't perfectly mirror the SP 500 due to factors like transaction costs, sampling errors, and dividends reinvested at different times. This tracking error is typically minimal for SPLG, but can exist. 2. Market events. Unforeseen events like market crashes or liquidity issues could temporarily hinder SPLG's ability to rebalance perfectly, leading to short-term performance deviations. Overall, with its transparent structure, rigorous tracking methods, and independent oversight, the SPLG ETF offers a high level of confidence in accurately replicating the SP 500's performance. However, it's crucial to remember that perfect replication isn't guaranteed, and investors should consider the potential for tracking errors and market-driven deviations. Question 5. Why might the SPLG ETF be considered a suitable option for investors seeking exposure to large-cap U.S. equities? The SPLG ETF can be a very suitable option for investors seeking exposure to large-cap U.S. equities for several reasons. 1. Low cost and tax efficiency. With an expense ratio of 0.02%, SPLG offers highly cost-effective access to the US large cap market compared to actively managed funds. Additionally, its structure generates returns of capital instead of dividends, potentially leading to tax benefits for some investors. 2. Broad diversification. By tracking the S&P 500, which includes 500 of the largest publicly traded U.S. companies, SPLG provides instant diversification across various sectors and industries. This reduces single stock risk and helps mitigate the impact of specific company performance on your overall portfolio. 3. Passive management. By passively tracking the index, SPLG avoids the risk of underperformance compared to actively managed funds that may struggle to consistently beat the market. This can be particularly appealing for investors seeking steady, long-term growth without the additional fees and risks associated with active management. 4. Transparency and liquidity. The holdings of SPLG are fully transparent, and the ETF boasts high liquidity due to the underlying S&P 500 index. This allows investors to easily monitor their investments and buy or sell shares quickly without significant price impact. 5. Benchmarking. Many actively managed funds use the S&P 500 as a benchmark. Owning SPLG allows investors to easily compare the performance of their active funds to the underlying market and assess their effectiveness. 6. Track record. While past performance is not indicative of future results, the S&P 500 historically has delivered strong long-term returns, making SPLG an attractive option for investors seeking potential capital appreciation over time. Suitability. Remember, not all investors are the same. SPLG might be well suited for 1. Long-term investors. Those seeking steady, diversified exposure to the U.S. market for long-term goals like retirement savings. 2. Buy and hold investors. Investors who prefer a passive approach and seek to avoid the complexities of active management. 3. Cost-conscious investors. Those prioritizing low fees and seeking to maximize their returns. Question 6. Why should investors be confident in the liquidity of the SPLG ETF, especially during times of market volatility? Several factors contribute to the expected liquidity of the SPLG ETF, even during periods of market volatility. 1. High underlying liquidity. The S&P 500 index itself is one of the most liquid benchmarks globally, meaning the underlying stocks are actively traded, which facilitates easy buying and selling of SPLG shares. 2. Creation and redemption mechanism. Authorized participants can create and redeem large blocks of SPLG shares directly with the issuer, ensuring a steady supply and demand for the ETF regardless of market conditions. 3. Market maker activity. Market makers actively quote, bid and ask prices for SPLG, ensuring narrower spreads and facilitating smoother trading even when individual stock prices fluctuate. 4. Passive management. Unlike actively managed funds that may need to liquidate specific holdings during volatile periods, SPLG passively tracks the index, minimizing the need for large asset sales that could impact liquidity. 5. ETF popularity. As one of the cheapest ways to access the S&P 500, SPLG enjoys significant investor demand, further contributing to its overall liquidity. 6. However, it's important to acknowledge some caveats. 7. Volatility can still impact price. While SPLG is expected to remain relatively liquid, extreme market volatility can still lead to wider bid-ask spreads and potentially higher transaction costs. 8. Large redemptions. If a large number of investors simultaneously redeem their shares, it could temporarily affect liquidity, although the creation, the redemption mechanism helps mitigate this. Overall, compared to individual stocks or actively managed funds, investors can have a high degree of confidence in the liquidity of the SPLG ETF, even during periods of market volatility. However, it's always prudent to monitor market conditions and be aware of potential liquidity fluctuations. Question 7. Why does the SPLG ETF not engage in active management strategies or attempt to beat the market? There are several key reasons why the SPLG ETF does not engage in active management strategies or attempt to beat the market here. 1. Cost effectiveness. By passively tracking the SP 500, SPLG can offer a significantly lower expense ratio, 0.02%, compared to actively managed funds, with fees typically ranging from 1% or more. This allows investors to keep more of their returns, as fees eat into overall performance. 2. Transparency. SPLG's holdings are fully transparent, as it simply holds all the stocks in the SP 500 in proportion to their weight in the index. This allows investors to easily understand what they are invested in and track the performance of their holdings. Actively managed funds often keep their investment strategies secretive, making it difficult to assess their value proposition. 3. Tax efficiency. SPLG generates returns of capital instead of dividends, which can be tax advantageous for some investors, particularly those in high tax brackets. This is because returns of capital reduce the cost basis of the investment, potentially lowering capital gains taxes when the shares are sold. Actively managed funds, on the other hand, often distribute dividends, which are taxed immediately. 4. Market efficiency. The efficient market hypothesis posits that all available information is already reflected in asset prices, making it difficult for active managers to consistently outperform the market over the long term. SPLG avoids the risk of underperformance by simply tracking the market as a whole. 5. Diversification. Passively tracking an index like the SP 500 provides instant diversification across hundreds of companies, reducing exposure to individual company risk. Actively managed funds may hold fewer stocks, potentially concentrating risk if their stock picks underperform. 6. Liquidity. SPLG enjoys high liquidity due to the underlying SP 500 being a highly traded index. This allows investors to easily buy and sell shares without significant price impact, unlike many actively managed funds with potentially low trading volumes. However, it's important to acknowledge that this passive approach comes with its own limitations here. 1. Limited potential for outperformance. SPLG aims to track the market, not beat it. Investors seeking higher potential returns through active management or targeting specific sectors might choose different investment vehicles. 2. Market exposure. By tracking the market, SPLG is subject to the same risks as the overall market. Investors seeking to mitigate specific risks might need to consider additional diversification strategies. Question 8. Why might the SPLG ETF be preferable to individual stock picking or actively managed mutual funds? The SPLG ETF can be preferable to individual stock picking or actively managed mutual funds for several reasons, depending on your specific circumstances and investment goals. Here's a breakdown of the pros and cons of each approach. SPLG ETF. Pros. 1. Low cost. With an expense ratio of 0.02%, SPLG offers one of the cheapest ways to access the US large-cap market. This means more of your returns stay in your pocket compared to actively managed funds with higher fees. 2. Diversification. By tracking the SP 500, SPLG automatically invests in 500 companies across various sectors and industries, reducing your exposure to individual company risk. 3. Transparency. You know exactly what you're buying, as SPLG holds all the stocks in the SP 500 in proportion to their weight. 4. Passive management. It doesn't attempt to beat the market, eliminating the risks and costs associated with active management strategies. 5. Liquidity. You can easily buy and sell shares due to the high liquidity of the underlying SP 500 index. 6. Tax efficiency. Generates returns of capital instead of dividends, which can be advantageous for some investors in high tax brackets. Cons. 1. Limited potential for outperformance. It aims to track the market, not beat it, so investors seeking higher potential returns might need to look elsewhere. 2. Market exposure. You're exposed to the same risks as the overall market, limiting your ability to mitigate specific risks through targeted investing. Individual stock picking. Pros. 1. Potential for higher returns. You can potentially outperform the market if you choose the right stocks. 2. Customization. You have complete control over your portfolio composition, aligning it with your specific investment goals and risk tolerance. 3. Direct involvement. You can participate actively in managing your investments and gain valuable knowledge about the market. Cons. 1. Time commitment. Requires significant research and analysis to select and monitor individual stocks effectively. 2. High risk. You bear the full risk of underperformance if your stock picks falter. 3. Large capital. May require a significant amount of capital to achieve meaningful diversification. 4. Emotional decision-making. Can be susceptible to emotional biases and impulsive trading decisions. Actively managed mutual funds. Pros. 1. Professional management. Experienced fund managers actively research and select stocks, aiming to outperform the market. 2. Diversification. Provides access to a diversified portfolio managed by professionals. 3. Convenience. Less time commitment compared to individual stock picking. Cons. 1. Higher fees. Expense ratios are typically higher than ETFs, reducing your overall returns. 2. Performance uncertainty. Past performance isn't guaranteed, and actively managed funds often underperform the market after fees. 3. Limited transparency. You may not know the exact holdings of the fund, making it difficult to assess its risk profile. Question 9. Why might the SPLG ETF be a suitable option for investors with a long-term investment horizon? Several factors make the SPLG ETF a suitable option for investors with a long-term investment horizon here. 1. Potential for capital appreciation. While past performance is not indicative of future results, the SP 500, which SPLG tracks, has historically delivered strong long-term returns. Over the past 50 years, the SP 500 has averaged annual returns of around 10% before inflation. This makes it a compelling option for investors seeking to grow their wealth over the long term. 2. Compounding interest. Long-term investment horizons allow investors to benefit from the power of compounding interest. Reinvesting earnings and dividends over time can significantly amplify their overall returns. The low expense ratio of SPLG, 0.02%, helps maximize the compounding effect by minimizing fees. 3. Diversification. SPLG offers instant diversification across 500 large-cap U.S. companies. This reduces exposure to individual company risk and helps smooth out portfolio volatility, which can be advantageous over longer time frames. 4. Reduced emotional trading. With a long-term perspective, investors are less likely to make impulsive decisions based on short-term market fluctuations. The passive nature of SPLG eliminates the temptation to time the market or react emotionally to market movements. 5. Automatic rebalancing. SPLG rebalances its holdings quarterly to maintain its alignment with the SP 500. This helps ensure your portfolio remains diversified and maintains its desired asset allocation over time, even if individual stock prices deviate. 6. Tax efficiency. For some investors, especially those in high tax brackets, SPLG's structure of generating returns of capital instead of dividends can offer tax benefits. This is because returns of capital reduce the cost basis of the investment, potentially lowering capital gains taxes when the shares are sold. However, it's important to remember that 1. Markets are inherently volatile. Even over long periods, the market can experience significant ups and downs. Investors with a long-term horizon should be comfortable with potential volatility and not expect guaranteed returns. 2. Passive investing doesn't outperform. SPLG aims to track the market, not beat it. Investors seeking higher potential returns may need to consider additional strategies or actively managed funds with their associated risks and fees. Alright, folks, that's all the time we have for today on the SPLG ETF. So, before you hit that subscribe button and smash that like button, let's recap here. 1. Low cost. SPLG boasts a tiny expense ratio, keeping more money in your pocket. 2. Passive and transparent. Sit back, relax, and let the SP 500 do its thing. You know exactly what you're invested in. 3. Long-term potential. Historically, the market has rewarded patient investors, and SPLG offers a way to track it efficiently. 4. Diversification. Spread your bets across hundreds of companies, reducing risk. 5. Tax efficiency. For some, the structure of SPLG offers potential tax benefits. But hey, if you're looking for a low-cost, transparent, and diversified way to access the US market, the SPLG is definitely worth considering. Hit that subscribe button for more ETF breakdowns, investing tips, and financial insights right here on Chat ETF.